So I do this webinar quite a bit with our clients to help them understand how to um, improve their cash position in their company. And so just a little bit of background on myself. I've been a CPA for 30 years now. I stopped practicing about 15 years ago when I started this company, Assured Strategy. I've started, grown, and sold 5 different companies. This is my 6th one. And I discovered the scaling up system when I owned my CPA firm. And scaling up used to be called the Gazelle system, but I discovered this system. And what was the driver around scaling up and scaling up in the cash sense was I had been running a company and it started growing really rapidly. I think the first year we probably had like a 3,000% growth year over year on the second year. And then it was down to 700. It just kept on growing, but the numbers were still really high. And then we just stopped all of a sudden. That was really because I was a typical entrepreneur. I was a control freak. I started to try to control everything in my company. And what ended up happening is scaling up changed that for me. It taught me how to plan my company out and use a planning system to understand what's going on instead of being involved in every little thing. So scaling up has 4 quadrants to this. It's the people, the strategy that you're going to execute in your company, the execution of that strategy, the discipline, the focus on priorities, and then cash. So people, strategy, execution, and cash. Now, cash is the thing we're going to talk about today. And how I really relate to cash is like the lifeblood of the business. So cash actually keeps the business running. And a lot of people, when they think about cash, they understand that cash is important, but they don't really understand what cash is doing. And so this is going to sort of explain that. And it's going to sort of teach you how to read financial statements and teach other people how to read financial statements. And we're going to talk about a few different things. So the first thing is the why behind why are we doing this workshop? I would tell you that most of the middle leaders we see inside a company and quite a few senior leaders don't understand how to read financial statements. And if you're leading inside of a company, you really need to understand how to read financial statements, because reading financial statements helps you understand what happened. So it's sort of like when you're driving, it's like looking in the rear view mirror to see what's going on behind you so nothing comes and hits you by mistake. So financial statements are historical in a sense, but they do give you some data because it's like looking in the rear view mirror of your car. You don't want to do everything from the rear view mirror, but you do want to glance back there every once in a while and look. I want to start off with the cash conversion cycle. This is one of the tools in scaling up, and we did email out this tool. This tool is really important. So this is the time I spend $1 till the time I get $1 back. And in this cycle is my cash. And so if you think about this cycle, if I'm turning $1, in other words, the time I spend $1 to the time I get $1 back, if I'm doing that 3 times a year, if I'm turning the dollar 3 times a year, if I could turn it 4 times, all of that fourth turn is going to my profit and my cash, with the exception of the variable costs that I incur as I'm going along in what I do. So this is one of the ways that we really help people get more cash into their company. And how do I speed up these cycles? I know when I first started with scaling up, I looked at this cash conversion cycle, and I sat there and I glanced at it for a couple hours, and I was just going, oh my goodness, this is so important. Because as a CPA, if somebody asked me to help them with cash, I spend a lot of time over here, where a lot of cash lives over here. And let me give an example of that. In the sales cycle, is if I'm taking 9 months to complete my sales cycle and I can get it down to 6 months, that can save me a tremendous amount of money and actually give me more opportunity. And I'll share that in a minute. But so the time I spend $1 till the time I get it back. So let's go over and talk about that sales thing. Here's the tool that I actually sent out to everybody. And here is the conversion cycle right inside of the tool. And so what we're doing is we're thinking about 3 different things. How do I shorten my cycle times? In other words, how do I shorten that 9 months down to 6 months? How do I eliminate mistakes in the cycle? And how do I improve my business model so it becomes more efficient at delivery so I can increase my cash flow? Okay, so if you think about this, and then let's go back to the sales cycle that we were talking about just a few moments ago. So I'm at 6 months, and if I can get it down to 9 months, then I can actually speed up my cash cycle. So if you think about it, what's causing my cycle to take 9 months? What are some of the common objections that we get in selling? What are some of the things that happen in the selling process that slow us down? Why is the customer taking a month to review our proposal? How do we speed that up? What questions are we commonly get? So these are all the questions that go into this cash conversion cycle. And I really love using this tool down at the lowest level of the company. And when I go down there and do this with employees, what I'll do is I can't tell them, hey, I want to improve your guys' cash flow and I want you to participate in that. And we're going to shorten cycle times, we're going to eliminate mistakes. What I usually do is I just go down and I ask them, I say, get an easel board and I'll have it sitting up there and I'll have an audience and I'll say, what are some of the things that are taking us too long in our cash? And then, or where are we wasting cash? So what's taking too long to get the cash flowing, or where is the waste? And employees will just start spouting off things. And one of the things that I've always been interested in is when I ask at the end of doing this, why haven't you given your management team or leaders inside of the company some of this information? What I get is the answer is they never ask. And if you really think about this from the standpoint of being an employee, I'm a little frustrated, especially if I'm a company that's having cash flow issues. As an employee, I could get a little frustrated because I want a raise and the company can't afford to give me a raise. And when I go down and start asking these questions, they know where the company's wasting money. And a lot of times the employees are frustrated because they want a raise, they see you wasting money, and then you say you have no money. So this is a very good way to go and start to think about it. But I can even do this with the executive team. I could do this with the sales team. I could do this with the HR team. I could do this with the IT team. I could do it with every team. And I could come up with pages and pages of things. I had a client once tell me, hey, Dave, we got a good handle on our cash flow. We don't need to do this. We did this. They had 6 pages in 20 minutes of things they could do to improve their cash. And they improved their cash even more, which allowed them to take advantage of some things when the economy started to turn. So when you think about this and you're thinking about the cash conversion cycle, how do we speed up the cycle time? Well, an example, and I know this is a little bit of a dated example, but it's a really good example for helping people understand this. This is Dell's computers, and they went from 63 days in 1991 to minus 21 days. How did they do this? Well, first of all, they got out of their own way. Because I'm sure if you would have sat in this meeting when they were trying to figure out how to improve their cash flow, somebody would say things and somebody would say, that's not the way it's done in this industry. So we have to get that out of our mind right away. But anyway, back in 1991, when we bought something from Dell had commercials on TV. They would put up a 1-800 number, we would call and we'd say, hey, Dell, I want a computer. And they would go, okay, great. We'll take all your information and we'll ship you the computer. We should ship it in about a month. So they ship the computer. About 2 months later, it finally shows up to my door, and the postman brings it to my door. They knock on my door. I answer. They say, "Hey, I have your Dell computer." And I say, "Hold on, I got to go get my checkbook." This is the way things used to be done. And so I would go get a check and I would give the check to the postman. The postman has to take it, deposit it. Then it slowly gets back to Dell 63 days later, right? So how do we speed this up? At the time that Dell was going through this, they were trying to raise $35 million in equity. The best offer they had was 40% of the company. And so they were trying to raise this money and they couldn't they didn't want to give up 40% of the company. So they kept on trying to think of ideas. What they decided to do is take credit cards over the phone. Yes, and Dell was one of the first companies that took credit cards in advance of you getting the actual product. So they sort of changed the way we buy things all the way around. And a lot of people don't know that, but that was in the mid 90s when this actually happened. And they went from 63 to minus 21 days. When they did this, in the first 30 days, they raised $38 million. They took care of all of their need that they were trying to raise money for. And so this is how this cash conversion cycle can really change your business when you start to think about how to speed things up, how to change the processes. And again, they probably had to get out of their own way because there was probably somebody in the room saying, "Hey, this isn't how it's done." Okay. All right, so let's go on to and to this next slide. I love this slide because growth and profitability sit on top of liquidity. Liquidity is the key. I have to have cash or else I don't pass go. I don't collect $200 if you've ever played Monopoly, and the game is over for me, right? So that's how I want you to think of cash. It's like the blood that flows through your body. If I don't have blood flowing through my body, I'm not alive anymore. If the business doesn't have cash flowing through the business, it's not alive anymore. More businesses go out of business from too much growth and not enough, if you know what I'm saying here. Oftentimes people think that they grow, a business goes out of business because it doesn't have enough business. That's not true. They grow too fast and the cash runs out and they can't collect it fast enough, or they have too much inventory or too many fixed assets for what they actually need, and they just run out of cash and they can't go forward. So it's a really interesting when you start to look at this and see it. This is inside of the scaling up system. This is the Rockefeller Habits checklist. And the Rockefeller Habits checklist is the scaling up system. And I'm not showing you this because I want to go over this with you. I don't. I just want to point one of the items out, and that's number 2. And number 2, what it says is everyone is aligned with the number 1 thing that needs to be done, accomplished this quarter to move the company forward. Well, if I'm having cash flow issues, this form can help you find that one number that you really need to concentrate on. For a lot of manufacturing companies, this number is waste. I just was on a call, I think yesterday, with one of our clients, and we were going through and we were talking about how they improved their cash position so much. And one of the things the COO told me, she told me that what they really focused on was getting control of waste. And again, how do I eliminate mistakes? Waste is mistakes. And it was very expensive. They were spending a lot of money on mistakes. And so this really helped them get cash back into their business. Accounting terms. Now let's get into how to read financial statements. So cash conversion cycle, how do I improve my cash flow? Now we're going to talk about financial statements and how to read them, because oftentimes people don't understand this, but it's not as difficult as people like to make it. I've worked with a lot of accountants over the years. I owned a CPA firm and have worked with a lot of CPAs too. And I'll tell you, they make this so hard, and it doesn't really need to be that hard, but we need to think about terms. And we talk about this with our clients a lot. What is the language of your company? And so if you think about it, we have revenue and we have sales. I cannot tell you how many meetings I've been in where somebody's talking about sales and somebody else is talking about revenue, and these are two different things. Revenue, from an official accounting perspective, is when the earnings process is complete. That means all the work has been done and all the benefit has been provided the customer, and that I can recognize revenue. Sales in some companies may happen today, and we may not recognize the revenue for a year and a half. And so I've been in conversation where people were talking about sales when somebody else was talking about revenue, and they were using these terms interchangeably. So we need to make sure that we're using the right term and that we understand each other. So oftentimes I'll say, somebody's talking about revenue, I'll say, are you sure you're talking about revenue and not sales? And sometimes I'll go, oh no, I'm talking about sales, not revenue. And I go, okay, we just want to make sure we're using the right terms. Cash flow, same thing. Income statement, profit and loss. These two are actually the same thing. And I just wanted to tell you that because a lot of people think that they'll use profit and loss, and then somebody will say income statement. They go, well, no, we have profit and loss. Well, it's the same thing. So these two are identical. So understanding accounting terms, basic accounting terms, is probably a good idea. Okay. What are financial statements? So when I ask for a client to give me financial statements, oftentimes what they'll give me is they'll give me a balance sheet and they'll give me an income statement. But unfortunately, this is not financial statements. Financial statements is a plural term, and it implies three different statements at a minimum. Okay, it's a balance sheet, an income statement, and the cash flow statement. This statement may be new to you. If you're looking at it right now, it may be the first time you're actually seeing one. Every single time your accountant gives you your financial statements, this statement should be included. This is probably one of the most important statements for an operations person to understand what's happening with cash. And I'll come back to this in a little while, but you can see on this operating cash flow, it's 13,000 or 13 million, excuse me, these are in zeros. So this is 13 million in operating cash flow. So the company generated 13 million in cash flow from operations. It had 20 million in profitability. So $7 million is lost behind the curtain. Now, it doesn't mean they're not going to get it, but I'm just trying to help you understand profit is not cash flow. So those two things are not the same. And there's three sections to this statement: the operating cash, the investing cash. And how I help people understand this is the investing cash is all long-term investments in things, fixed assets, buildings, things that last longer than 1 year. That's what we actually put in the investing cash flow. So under this one, they had actually bought a building for $15 million. That's what this 15 million is on here, as they had spent that money on that building. Then financing cash flow is debt we incur, as well as dividends or equity that we get, or equity that we pay out. Like this is dividends, so we actually have negative cash flow because we paid out some dividends. Okay, and that's not going to show up on this income statement. So a lot of times when you're looking at this this net profit, it may be 20,000. If we paid out 10,000, or I keep on saying 1,000, but this is 10 million, then we don't have 10 million or 20 million in cash. We have 10 million in cash left because we took some out. And I'll show you how this works and interacts in just 1 second. You can see down here at the bottom, then we have the beginning cash, the change in cash, and then the ending cash balance. Okay, so this is the cash flow statement, and I'll show you how these things interact with each other. But let's talk about the balance sheet first. The balance sheet. What is the balance sheet over here? The balance sheet is the accounting equation. And if you remember algebra, and some of you may not want to remember algebra, but one of the basic formulas in algebra is A plus B equals C. That's all a balance sheet is. A, assets, B, liabilities, plus equity equals the assets. So the assets plus the liabilities plus the equity. And so these two numbers balance each other. And then if you think about this from the equal sign, so what you do to one side of the equal sign is what you have to do the other side of the equal sign, and that's debits and credits. And I'm not going to go too far into debits and credits on this call, but I would just tell you that debit, that's how it works. And that's what this balance sheet is doing. Okay, so let's think of a balance sheet. And I want you to think about it like a picture. Okay, so you can only take a balance sheet at a moment. So it's like a picture. If I pull up the balance sheet 3 hours from now, the picture will not be the same. It'll be different. Okay, so you want to think about a balance sheet like a picture or a snapshot in time. Then we have an income statement. Now, an income statement is like a movie. It's constantly moving. Think about that. Like if I have intangible products that are being sold on the internet, I could be selling at 3 o'clock in the morning. I could be selling at 5 o'clock in the morning. I could be selling at 1 p.m. So it's constantly moving and changing. All right. And then the cash flow statement is what cash comes in and what cash goes out, and it's all just cash. So in accounting, we have a thing called accruals, and you probably have heard of that before, and most financial statements are done on the accrual basis, okay? Some people use cash when they're smaller, but sooner or later they have to switch over to the accrual basis. And I would suggest to you that if you're not using the accrual basis, you're not getting good data to run your company, because cash basis does not provide good data. There's a thing in accounting called the matching principle, where we're matching the expenses with the revenue that we generated. And sometimes we incur the cost in advance. So if I buy inventory under the cash method, I would just expense it when I buy it. Under the accrual method, I'll put it on the balance sheet and I'll bring it over to the income statement as I'm generating the revenue from that sale. Okay, so I'll go through this a little bit more. So here I sent you the sheet, and I sent it to you so you could take some notes as I'm going through it. So here's cash, 50 million. Okay, we have change in cash was 17 million. And the ending cash balance was 33. So here's a balance sheet at the beginning of the year, a balance sheet at the end of the year, two snapshots in time. The income statement is the movie running through this. So the movie, under a normal accounting terms, we are think about it in 12-month increments all the time. So the income statement is usually 12 months, but it could be 1 month. It could be 4 days. So it's the movement between the two balance sheets. Okay. So you have a cash balance, then you have an AR balance. So you have 180 million in AR. You have revenue of 210 million. I would tell them that they're probably in a lot of trouble if this is the case. All right. And then they collect 200 of the 210 they sold. So their AR actually increased by $10 million by the end of the year. Okay. Hopefully you can see that okay. Then the inventory does the same thing. So it's at 200,000. We use 65 million. I said 200,000 again, but it's 200 million. We use 65 million of that money, okay, of the inventory. And then we bought 60 more million of materials. We ended up with inventory of $195 million, right? So what ends up happening here, you can see it. Here's the inventory. Here's the cost of the materials on the income statement. Here's the actual cash we paid. So we bought some stuff and we still owe for it, probably, is what I'm guessing, right? And then here's my inventory at the end. I decreased my inventory a little bit because I used more than I bought. All right. Then my direct labor, I paid for it right at the time. My fixed assets, I have depreciation on my income statement. So I buy an asset, it lasts for 5 years. So if I paid $25 million for an asset and it lasted 5 years, I'd be depreciating 5 million of that every year for 5 years. Okay. So if you think about it, as I'm using the asset, I'm expensing it against the revenue that it generates. So you see that matching principle and the accruals coming into play here, right? Then we went out and bought a building for $15 million. So I ended up with a net of 230 million. So 220 minus 5 is 215. And then I increased my assets by 15 million, taking away 15 million of cash, okay, buy that asset. So I have 230 million left. So this is my cash flow statement. Then I have AP. I owe 180 million. My expenses are 58 million. I made payments of 62 million. The change is 4 million. So at the end, I have AP of 176 million still. Then taxes, 3 million is due. My income taxes on my income statement is 7 more million. So I paid all 10 million. So I don't owe any more taxes right at this time. So it helps you see what's happening to the cash. And you can see the difference. This is on the balance sheet. This is all that was on the income statement, but this was the cash. So we spent 3 million more than is on the income statement. So I don't care what the net income is because we spent 3 million more. Over here, we spent 4 million more. Over here, we spent 10 million more. So we actually spent more cash than we had come in. So you can see that right here. This is the change in my cash flow. And then you have net profit, the retained earnings. This is the net profit. We distributed 10 million of that net profit, and we ended up with 10 million increase in retained earnings because we took the money in. This is the money that we had profit, and we distributed 10 million of that profit. And then this is how we ended up with this number. So you can sort of see the cash flow statement in here and the change in cash right here. So this is usually the sheet that I help people start to understand cash and what happens. And the enlightenment really comes in this column when you start putting the actual cash that went out the door. A lot of times it doesn't match up to the expense side on the income statement. So I could have 20 million, but as you can see, we spent 20 million plus another 17 million buying a building, but people often forget about these things that they buy. That's why the cash flow statement is so important, because it actually tells me that I bought an asset worth $15 million. So it's my cash may have decreased, but I do have more assets now. Now, this is how to basically think about and read a financial statement. And then how are financial statements presented? Here's an example of a financial statement that I took and I did some analysis on it. And analysis doesn't have to be complex. I can run ratios on these financial statements. I can do all kinds of things. But all I did right here was just put the percentage of revenue. So everything is the percentage of revenue. So our cost in this scenario was about 79% of the revenue. Okay. And then you can see in the next year, it was 68%. Well, this is a huge shift for this company. They've increased their profit, their revenue by 40%, and decreased their cost quite a bit too. So the change was quite a bit. It only went up, the cost only went up 29%, the revenue went up 49%. So they benefited from this. Now, what's the biggest thing that they did? As you start to look down the expenses, you could start to see, what did they do to fix this problem? Well, the training line went up a lot on this company. I'll tell you, one of the biggest game changers to cash, profitability, and everything is training. It's training and getting people to understand what their jobs really are. And so what did they do to fix the profitability? Because you look, they had $1 million of profitability, and then they ended up with $6 million the next year. What did they do? Training was the difference. That's what they actually did. This number right here was what changed everything. So 300,000, they increased it about $250,000, 250% increase, but they increased their bottom line by 476%. I don't know about you, but I would spend this money all day long if I knew that I was getting this result. So that's why you sort of want to get your financial statements in a percentage, because it's easier to start to look at the ratios of what's happening instead of just looking at the raw numbers. Oftentimes when I'm seeing financials presented at meetings and things like that for clients, they're just presenting the numbers when ratios would really help with that. And I'm speaking to, hopefully some accountants are watching this, because I would tell you that a lot of accountants don't produce these financial statements so people can actually use them. Okay. Now let's talk a little bit about waste, because waste is something that probably kills cash flow the most. And this is a great example. So let's say that I own a HVAC company, HVAC company. Inside of the HVAC, and those of you who are watching this, if you're watching this after the fact and you're an HVAC company, please forgive me if I don't know all the technical parts of an air conditioner. I'm going to take some liberties here to just use some examples. So let's say that each of these air conditioners have a motherboard on them that's sort of controlling the air conditioning. So these motherboards, they go out every once in a while. They get calls from customers, so they know this machine, and they know it's usually, there's 3 things that commonly go wrong. So the repairman makes sure he has the common parts. One of them is the motherboard. Okay. So they go over to the house, they inspect it, they determine that it is the motherboard's out. They go to the truck, they grab the new motherboard. On their way back to the air conditioner, they have too many things in their hand, and they drop the motherboard, and it cracks and it breaks. Okay. To the employee, all they did was accidentally break a motherboard. But I want to show you the implications of this. And when you start teaching employees this, they really start to understand things. So if you can break things down like this in your own company, employees really start to understand the impacts of breakage, of waste, things like that. So here we are. We sell the motherboard for $1,000. It costs $500. We buy it for $500. The labor is $200 to install it, and we allocate about $100 of overhead to this product. Okay, so we end up with profit of about $200, which is pretty good profit. 20% profit on a motherboard replacement is pretty good profit, if I can bring that to the bottom line. But it got broke. Remember, he was carrying too much stuff and he dropped it and it broke. So now this visit has been a wasted visit. So I spent the $500 on the broken motherboard, I spent the labor costs, and I spent the overhead, but I didn't get any revenue because I didn't fix it yet. You see what I see how I'm doing this now? So I have a cost of $800,000, and this is my profit, but I have to still install it. So I lost the $200 and I lost the $800. So the question is, how many do I have to sell to break even again? Right? And the answer is actually 5 to get back to 0. So I have to sell 5 more motherboards just to get back to 0 for the one that was broken. And let me show you how this works. So the first one, this is my cost because I didn't get to sell it. So I had to do it again. I ended up getting the $200 profit, but now I have to sell 4 more. Okay. because I have to make up for the $800 that's lost over here just to get back to the same profitability I would have had selling the one. So now I have to sell 5 to make the same profitability that I would have had if I would have not dropped it. And when we start to teach employees this, because they think they just dropped the silly motherboard, right? It costs $500. What's the big deal? Well, the big deal is I have to sell 5 more of them to make up for the one you broke. Okay. And when employees start understanding this, it's really starting to be a game changer. All right. So hopefully these things help you. So we have the cash conversion cycle. We talked a little bit about that. What do I need to do to speed up my sales cycle, my make and buy cycle, my delivery cycle, my payment cycle? What are things I can do to eliminate mistakes, improve my business model, and really speed up the cycle? Okay. And then the next thing we talked about was how to look at financial statements. So what are financial statements? The balance sheet, the income statement, and the cash flow statement. It's not just the balance sheet. It's not just the income statement. I was talking to a business owner the other day, and he said to me, he said, I sold my first company, and I surely wish I would have understand the balance sheet, because the second company, I actually understood it, and I sold it for 5 times more than I thought I was going to sell it for, because somebody taught me the balance sheet. The balance sheet is really what you have to understand to get the value out of your company. And cash flow is the king of all of that. I have to have cash if I want to stay in the game. Okay, so then that's all I have for you today. I don't know if you have any questions. Does anybody have any questions? I'll open it up. If anybody has any questions, we can go back to a slide if you do. Okay, well, thank you very much for coming. We appreciate you joining us on our webinar, and have a great day. And if you have any questions, feel free to reach out and email me. I will be sending out, for those of you who came, I will be sending out the PowerPoint to you. And if you have any questions, feel free to reach out. Thank you very much. Have a great day. Thanks, Ted.